Hi folks, hope your Independence Day celebrations went well. Post the budget, there were a lot of tax changes and people got angry about this. However, as investors, we need to consider that taxation is one part of the investment process. It should not be the most important reason why you're choosing to invest in an instrument or you're refusing to invest in a particular instrument. So I have taken the case of international funds here because over the last few years there have been three changes, and this helps us to develop a scenario to understand the impact of taxation. But first of all, why should we consider international funds? So international funds are funds that invest in stocks which are based in exchanges outside India. For example, let's look at the Kotak Nasdaq 100 fund of funds. So when we invest into this fund, Kotak Mutual Fund takes our money and then uses it to buy units of the iShares Nasdaq 100 fund. iShares is a mutual fund company which is based in the US. It tracks the Nasdaq index and buys and sells according to the changes in the index. So Kotak uses the invested money to buy units into the iShares fund. They are not managing the fund per se, or they are not tracking the fund. They are only buying units. Similarly, the Edelweiss US Technology Fund uses the money invested to buy into the JP Morgan US Technology Fund. JP Morgan US Technology Fund is an actively managed fund. By this, I mean JP Morgan uses the money invested in this scheme to buy and sell US technology stocks. Now, I've created three scenarios here. The first is the taxation, which was there pre 2023 April. In that case, if the units were held for more than 3 years, then the taxation was at the rate of 20% after indexation benefit. On 1st April 2023, the taxation had changed whereby no benefit was given. The gains were added back to the investor's income and taxed at the slab that was applicable. In 2024, post this budget, the taxation has changed again. If you hold the units for more than 2 years, then you will be charged tax at the rate of 12.5% on the gain. So in this example, these are assumed values. Therefore, please refer to the scheme before investing into these funds. Now, I've assumed that on 1st August 2019, that is 5 years back, the investor put in 1 lakh rupees. And as I mentioned, the assumed annual return I've taken is 15%. Therefore, after 5 years, in August 2024, the value of the investment is at 2.01 lakhs and the investor has decided to sell it. So the capital gains works out to 1,01,136 rupees. Now, in the first scenario, there was an indexation benefit which was given. So I could increase the purchase value as per the cost inflation index and show a higher purchase value, which in this case works out to 1,25,000. Whereas in the other two scenarios, I did not get any indexation benefit. So the purchase value remains the same. Therefore, the capital gains now in the first scenario is lower. It looks like it shows 175,531, whereas in the next two scenarios, it is the actual capital gains, which is 1,01,000. The rate of taxation is also lower in the first scenario, which is 20%, whereas in the second scenario, I have assumed that the taxpayer is at the highest slab of income. Therefore, I've assumed 30% taxation. And in the current scenario, since the example shows that the investors held these units for more than 2 years, they are getting the long term benefit, which is 12.5%. Therefore, the tax is different across all three scenarios. That is, in the first scenario, they have to pay 15,000. In the second scenario, it's 30,000. And the third scenario is 12,000. Therefore, the net gain becomes 1.86 lakhs, 1.70 lakhs, and 1.88 lakhs. As you can see, the person who had invested in 2019 would have considered the indexation benefit and a rate of 20%. But in 2023, they would have been caught flat footed because suddenly the indexation benefit was taken away and the taxation was at the applicable rate of taxation as per the income. So this could have been a shocker to the investor. But did the underlying reasons for investing in the fund change? No. Geographic diversification was still a good idea. The uh, professionally managed funds was still a good idea. But the risks also remained, which was that there could be changes in currency valuation, there could be changes in the socio-economic factors which are beyond our control, and changes in taxation could also happen like this. So at that time, the investor would have had to take a decision whether to continue or not. Now, thankfully, the taxation changed again in the third scenario. And this brings us to the current net return which can be expected considering the investor would be selling now, which is 13.5%. So it is still a good return compared to the earlier scenario which was there. Now, as a standalone investment, it is always difficult to assess whether this has done well or not. But when we compare against other instruments, then it becomes easier to understand. So let's take a comparison against a large cap fund which is investing in Indian equities. So in this scenario, I've taken the same amount of investment, which is 1 lakh, but I've considered the rate of return as 12% here, which is the normal baseline, which is expected for a long term return from a large cap Indian equity fund. Therefore, my sale value becomes 1.76 lakhs since I've assumed a lower rate of return, and my gain is 76,234. There's no indexation benefit here, so my net gains remain as 76,234. Now, since I've held these units for more than 1 year, I'm taxed at the rate of 12.5%. Hang on, there is no tax to pay here because the first 1.25 lakhs of gain is exempted and I have only gained 76,000 rupees. Therefore, the entire gains is given to me fully. So, I'm getting a net return of 1.76 lakhs and a net rate of return of 12%. So, is this favorable or not? I would not say that it is or it isn't, but the instrument has delivered well. Now, let's also compare against fixed deposits because I feel that fixed deposits are a safe and stable investment which anybody can easily invest into. However, fixed deposits do not beat inflation by a high margin. Therefore, it is important to invest in instruments that can give us significantly higher returns than fixed deposits. So, fixed deposits do not have a concept of short term or long term capital gains, and therefore there are no benefits related to this. I assumed the rate of return to be 7%. So, after 5 years, my current value goes to 1,40,000. My gain is 40,255 rupees to be precise. And once again, this gain is added back to the investor's income and taxed at the slab that he or she is in. So again, taken the highest slab, which is 30%. Therefore, the tax to be paid is 12,000 rupees and my net return is 1.28 lakhs. This shows that I'm getting a net return of 5.1%. Now, if I look at these scenarios, it is obviously better to go for an international fund. But an international fund has different risks from an Indian equity fund, which has different risks from a fixed deposit. So all these instruments have pros and cons. For example, fixed deposit is good to hold emergency corpus, to hold our short-term money. It's easily liquidatable. We are not worried. But equity funds are volatile in the short term. So we need to give it a long time. We need the markets to be favorable before we exit it. Now we can even look at cryptocurrency as an example. 30% on any gain at any point of time is charged. But if you're getting a high rate of return and you're comfortable with the volatility, then you may want to invest there as well. But if you're not comfortable with those factors, then you don't even want to take it up. So you're not looking at taxation as the main reason, you're looking at it as one of the reasons. And when you put all these reasons together, then you can decide whether to go ahead with the investment or refuse to participate in it. So I hope this helped you to understand the concept of planning your investments first and then looking at taxation as a advantage or disadvantage. If you have any queries, please do drop a comment or write it to us and we'll be happy to get back to you. Thanks for watching.